Good morning and welcome to Money Matters Live. My name is Nev, and we are, of course, doing the show every single day only on onedealaway.com/live at 7 a.m. Eastern Standard Time or Eastern Daylight Time, whichever one you want and prefer. And today we have an incredibly important show, probably the most important show that I have done this week. And this week has been packed with all kinds of important information of how you can actually preserve and protect your wealth. And of course, this comes because we are committed here, Money Matters, to talk about money matters because it matters and to be able to discuss how you can actually protect yourself in this crazy economics that we're all experiencing. So, we talk about general markets, business, what's going on in the world economy, what's going on in the local economy. We do cover cryptocurrencies. We talked about crypto a little bit yesterday and blockchain. We're going to be doing a little bit more this weekend. But today we have a very important and special show talking about real estate. So if you are a real estate investor, if you are in a city, if you are depending on income from the government, if you are in any way, shape, or form connected to money somehow, this show is incredibly important because we're going to be talking about what is going on in the world of real estate and how it actually affects you. And many people, when we talk about real estate, they think of, oh, it's just a home, it's just a place to live, or that's just for investors. That doesn't affect me. But it affects every single person. In today's show, we're going to be talking about what happens when a city dies. And I'm going to explain to you exactly how city is dying, how cities around the world in United States are actually dying and suffering, and how real estate is all connected to all of that stuff. So it's a very, very important show. You definitely, absolutely don't want to miss it. I want to welcome everybody watching this live on onedealaway.com. Good morning and welcome. As always, we're going to go into Q&A at the end of the show. And those of you watching on YouTube, welcome as well. Do me a favor, hit the subscribe button, hit the bell button so you get notified every single day when a new show goes live, which it does every single day since we do it every single day. And of course, do me a favor and hit that like button so that we can spread the news and help more people. All right, y'all, let's do this. And good morning. It is Friday, July 10th. I almost said June. But no, it is July 10th. So before you know it, middle of July is going to be here, end of July is going to be here. Then we hit into August, where all kinds of new things are going to come our way. And we are going to talk about specifically real estate here today because it is very important. And as I have mentioned, we're going to be discussing what is happening right now with real estate, with cities, with government, with money, and how it all affects you specifically. Because, it's one thing to just listen to the news and what's going on, but it's a very different ballgame when we start connecting the news and how it impacts us. And I believe that real estate is one of the very, very important industries and sectors in the economy, and it reflects and it has an impact onto every single human being, obviously from homes to offices, to retail, to all kinds of stuff. But it, of course, affects our money in the form of taxes. Now, you might already know that there's a thing called property taxes. And every single time you buy or sell a property, there's a taxable event. Every single time that you transfer property, there's a taxable event. And all of those taxes go actually to the government to be able to fund things like police, and fire departments and city workers and public transportation and park management, street management, cleaning, trash pickup. I mean, everything you can possibly think of that makes a town, a city sort of function and operate, not just towns and cities, but also the counties, the states, and entire countries. All of it is very, very connected to real estate. And we're going to be talking about what's going on in real estate from the perspective of individual that just is living in a particular place and location, all the way to investors and how we can talk about it. So we have all kinds of incredibly important news. So let's do this. Let's start talking about it. And the first article that we have here is talking about the U.S. prices drop 6.6% by May 2021. This is the first annual decline since January 2012. And now we're going to be talking about what's going on there. We're also going to be talking and covering what's going on in places like New York City and where people are exiting and entering, because that's going to be important. We're going to be covering all kinds of stuff, including what's going on in around the world. So you definitely want to stay tuned in, because we're going to start with this. We're going to jump to UK to understand this is not just a US based problem. And then we're going to continue talking about large cities. So CoreLogic, which owns the share Case-Shiller Home Price Index, released this monthly home price index forecast. And after years of being bullish about home prices, they are turning bearish. It forecasts that price of single-family houses, including distressed sales, would begin dropping on a month-to-month basis with the June reading. And they're expecting it to go down 6.6% year over year by May 21. Strong home purchases demand in the first quarter of 2020, coupled with tightening supply, has helped prop up the home prices. The anticipated impact of the recession are beginning to appear across the housing market. Surge in pending home sales and in purchase mortgage applications to level above June last year, supported by record low mortgage rates, continues to exceed expectations. By the end of the summer, under pressure from unemployment crisis, buying will slacken, and we expect home prices will show decline in metro areas. And by 2021, the National Home Price Index is expected to be down 6.6% from May of this year. So not from last year, from this year. CoreLogic Market Risk Indicator predicts that 125 metro areas will have at least 75% probability of price decline by May 2021. All right, we're going to pause here for just a moment to explain a handful of things, because we've covered a lot of stuff already and we just got started. So basically what is going on right now is, you know, that there's a large unemployment, and you know that the income is what drives what we can do and how much money we spend. In yesterday's episode, we sort of ended a little bit with real estate, talking about mortgage and the mortgage rates that have dropped to below 3%. So I want to say yesterday we talked about that it was 2.92%. And my expectation is that it's going to go even lower over the upcoming months. But the problem is that most people won't be able to go in, because what is today? Well, today is Friday, of course. Happy Friday to everybody. But it's July 10th. So in about 15 days, in 2 weeks, all of those special programs that were created in March to address COVID related challenges that we've all come up across are going to expire. They're set to expire. That extra $600 a week is expiring everywhere. The mortgage forbearances are going to start to go away, right? Because they were rolled out in March. So you have April, May, June, and July as month number 4. So a lot of them were 3 months. Some of them were 6 months. So we're going to start seeing, and of course, evictions. Evictions are ending at the end of July as well. So now, as we enter August, pending Congress doesn't change anything. It doesn't sound like they will, because they're going on recess. So they're going to be sitting on a beach somewhere in Hamptons, probably. I don't know. I'm guessing. But they're not going to be doing much of anything. And while there's some talks, remember, they're going on vacation. So all they're thinking is a lobster, beer, and chilling by the pool or the beach somewhere. So not much is going to happen. And so we're going to see a lot of evictions happening. So when you have evictions, of course, you have vacancies. We're going to be talking more about vacancies here, but all of those are going to start driving the prices lower in many, many areas. And we're going to be speaking specifically about some areas that are already hit and that are going to experience even larger problem. Okay, so We're going to continue now, so you definitely want to pay attention here. The Case-Shiller Index, which does not include distressed sales, sees disappearing gains in 2021, but no actual price declines. HPI forecast, which does include distressed sales, sees fairly steep declines. And you can see the graph right over here of what's going on. And you can take a look at it in a moment, but I'm going to explain the distressed. Distressed sales are basically sales that are in foreclosure, in short selling, in whether the foreclosure is based on taxes or based on mortgage. That's basically what the distressed is. It means that there's a lot of struggle, and when we look at the a lot of struggle piece, there's a very large expectation that a lot of prices will actually end up dropping. The impact of distressed sales becomes apparent during the housing bust, right? So, Core Logic sees some particular bad vibes for states like Arizona and Florida that are now confronting elevated COVID-19 cases. Economic and health crisis and the worst unemployment crisis in our lifetime is hitting a fairly strong, and it is going to have effects on what's going on. So, not only are we dealing with the economic pressures from A, aging population, but also B, economic components of the. So, first was demographic, right? Aging population and millennials who can't really afford it because they're saddled with student loan debts, which also payments are going to be restarting in August. Um, so a lot of things are coming in August without much, if any, help from the governments whatsoever. So everything that gets kind of propped everything and made everything sort of okay is going away. And that is a big problem. So we have demographics, we have economics with the inability to pay. Now we're going to see folks being removed out, all of the vacancies, nobody to fill them. So prices are going to continue to go down. And of course, the reason I'm expecting that the uh, mortgage rates are going to go down is because of this low interest rate that is here to stay for a while. And then we're going to see that the banks are surely going to start lowering, but the circumstances under which you have to buy are going to get higher. So it's going to get more difficult to actually go and qualify for loan. And of course, people can't qualify for loan if they don't have any income. And then on top of that, right, you can see how complex the situation and problem is. On top of that, what we're also seeing and experiencing is that the health crisis is not over. It just has shifted. We've gone from, New York City, for example, being the hot spot a couple of months ago to now having, some 29 states that are seeing a growth and rise in the health crisis. And it's not just in the United States. We're seeing this sort of mutation and rising happening around the world. Many of you know that I'm originally from Serbia. So, of course, I do watch the news of what's going on over there. And, they ended their quarantine a couple of months back, let everybody out. They went from military hours or the martial law, whatever, all the way to like, everything is open, freedom for everybody. Well, their cases have jumped through the roof. Now they're going back into the shutdown, and so people are rioting. We're seeing riots everywhere. All of that is affecting real estate and our money. So now we're going to jump into UK. And there's a massively large problem. Look how beautiful this picture is. Gotta love it. There's a massively large problem in home ownership. UK homes are expensive. They're ridiculously expensive, y'all. Very, very, very expensive. Millions of millennials and Gen Z are being forced to rent because they can't get on the housing ladder. But there's the rub. They can afford to pay rents, which are invariably much higher than mortgage payments would be. The problem isn't that houses aren't affordable. I disagree. I think they're very unaffordable, but whatever. The market failure is that there is just no mortgage financing available. Mortgage lenders are stuck to the same 3 times salary, 80% LTV, loan to value. That's what the LTV stands for. Formula they used when interest rates were 12%. We need a completely new approach to home ownership. And of course, this is coming from a company that is trying to do something very, very different. Think outside of box, which I kind of like, but I don't like because of the impact that is going to have on the people who don't understand, don't study what's going on with money and how they can benefit. They're going to jump in some of these things, and it's going to be this company that makes the money, not the person owning the place. Just putting it out there for you to understand. I don't agree with this 100%, but it is a way to potentially solve the problem, and people are coming out of woodworks to solve it. This is very important for you to understand. They're looking to create something unique and different, but I don't think it's going to be beneficial to people. It's going to be beneficial to the lender. Please pay attention. And if you don't understand this stuff, if you don't know what I'm talking about here, I do want to highlight and point out that on onedealaway.com, we have an academy where we teach you all kinds of stuff about money, all the way from real estate to basic money stuff to business stuff to crypto stuff. We're talking about all of those things, and you get all of those courses within the academy. The lender will fund co-ownership where they own up to 95% of the property. Remember, lender owns 95% of the property, not the owner. Key component number one to know and understand. Amount the borrower needs is effectively paid off as rent and is set by what the borrower can realistically afford. So they're going to play around with what you can afford, but every time they lower the price, they're going to jack up your interest. That is the only way that they can make money. I don't know this for a fact, but I'm just using my knowledge and experience within real estate, within business, within finance to explain what more likely than not they're going to be doing. The deal is structured so the borrower doesn't face a negative equity trap, but does pay an inflation-linked rent. So basically, what they're going to do is they're going to own 95% of the property. You're going to basically command how much you pay per month, but they're going to play on the interest. And then, of course, every single year, just like rent goes up, your mortgage payment is going to go up, and you're not going to own more of the property. If they want to increase their ownership stake or sell, they can, meaning you have to put in more money to get a bit more percentage of the property. UK residential property has always been strong performing asset. Well, historically, yes, but remember, real estate, just like everything else, is cyclical. It does not just go one direction. It goes two directions, actually three directions. It goes up, it goes down, and it goes sideways. And it is incredibly important for you as a person, as an investor, to understand that there are those components and that you do have an ability and a potential to make money regardless of which direction the market goes. All you need is a little bit of education, and you can get that at onedealaway.com/academy. So yes, I am biased about the academy. I am biased about it because I believe in it. So please understand that component. Water break. Now, what I do want to point out is that we were talking about the lender owns 95% of the property. Why is that problematic? I don't know if you've been paying attention, but I've been saying if it's not your vault, it's not your gold. If it's not your private keys, it's not your crypto. If it's not your ownership, it's not your property. Okay? You got to own it. You got to control it. Look at what's going on with Venezuela. They have gold in UK, in England. Bank of England is basically saying, we're not paying you. I don't care. Yeah, it might be your $1 billion worth of gold there, but we're not paying you. And they're coming up with all kinds of excuses. So learn from what's going on because this can absolutely happen to you as well. The goal and the piece to understand, it has nothing to do with countries. It has nothing to do with Venezuela. It has nothing to do with England. It has to do with power, control, and ownership. And those that are powerful and that have control, those that are big, get to control how everybody else is playing. It's kind of like a band at a dance. Whatever music they play, that's how you dance. Otherwise, you look silly or you get kicked out. So please understand that you and I are small fish. I don't care if you're a millionaire or multi-billionaire. You are a small fish when we're talking about larger economic forces and moves, and you have to be very, very careful about these things and understand them, okay? That is why I argue that the best, absolute best investment you can ever, ever, ever make is not crypto, is not gold, is not real estate, is not stocks, is not bonds, it's not futures or derivatives or any of that stuff. It is your education and understanding. All right. I'm done with the rant. Let's go in and continue our conversation about real estate. Real estate CEO expects exodus of central business district to last next 2 years. So what is going on? Businesses and dwellers out of city centers and downtowns into the outskirts in the short term, but demand can be expected to return to big cities, according to the head of the largest commercial real estate broker in the industry. Please understand when some of the news are reported, who is it coming from and why they would say certain things. When you are the large or largest commercial real estate broker in the country, you absolutely want to pump that industry, right? Because that's how you make money, right? Make connections, right? Suburban areas outside of major cities are in high demand, and we're going to talk more about this stuff. In the next 18 to 24 months, we're going to see show a lot of exodus out of central business districts and a lot of office vacancy. People and businesses are going to start moving into the suburbia, and they already have started. We've been talking about the mass exodus from the cities for the past few weeks, and that is continuing at highest numbers ever. Real estate searches in suburban zip codes spiked 13% in May, doubling the pace of urban growth. However, some of the larger cities seeing residents migrate to the outskirts include New York City, Seattle, and Miami. People are also flowing from primary metro areas that we just discussed to secondary markets such as Phoenix, Salt Lake City, and Nashville, Tennessee. Major metro areas could be on the 3 year recovery track. So they're basically arguing and saying, yeah, people are going to move out, but they're going to come back because that's what they've always done. We don't know that for a fact. What we do know for a fact is that people are exiting major cities and they're leaving. And what do we know about Seattle, Miami, and New York? Well, they're very, very expensive. San Francisco, same thing is happening. They didn't mention it in this report, but we've been talking about it, and we do understand that this has been happening. So let's continue with the news because we're going to be connecting the dots here in this particular episode. CEO of Century 21 Parent says suburban home search is up across the country following New York's lead. And you can see this is an interesting one. I wanted to pause for a moment. Evictions could hit the crisis level. So where are the biggest evictions going to be? New York, Florida, Texas, and California. So I am expecting that these markets, based off of this stuff, are going to see again a dump in prices, a dump in rentals. As New York City goes, so goes urban centers across the U.S. City dwellers and potential home buyers to flee dense areas like New York City and parts of California for suburban locations. We've been talking about it. We're continuing to talk about it because it is still happening and there's still time to actually play this arbitrage and change. What they're searching for has changed to be much more suburban. So we used to see people go from suburbia and rural areas into highly urban. Now people are pulling back, and a lot of it has to do with the health crisis that we've been covering. If you don't understand why, you definitely want to look for previous episodes. Simply go to YouTube channel Money Matters. You're going to click on real estate updates, and all of that stuff is right there so you can watch and understand. Millennials, now the largest cohort of homebuyers in the country, have been a key part of newfound urban exodus in the state. The trends have been a big effect on New York City home rental market, and we're going to be talking about that in just a moment. The momentum in the purchase and sale of the housing market has been quite strong now for a few months. However, they don't say this in the article, but I am telling you that is not going to last for forever because of what we just discussed earlier in the show. Now we're going to continue with sort of what is the impact of all of this migration of where people are going. How is this impacting New York City and how it can impact your city wherever you live? We're using New York as an example, not an outlier. Okay. This is going to be happening to all different places and cities. Okay. Because people equal taxes, equal money, money for the government, equal services, and all kinds of stuff. So cities are dying a very slow death, and here is why. Here is where we're going to get into the meat of stuff. Number of apartments listed for rent in Manhattan reached record levels in June. More than 10,000 apartments were listed on the markets in June, an increase of 85% over June 2019. Almost double, y'all. Almost double. Official vacancy rate hit a record of 3.67. Okay. But that is going to continue rising. And that is my professional opinion, not just personal opinion, professional opinion. Exodus from New York City has left a rising number of vacant apartments and fewer new renters arriving to fill them. In an effort to fill those vacant apartments, landlords are dropping prices and offering ever larger incentives. Average rental price, including concessions, fell 8% in June, and I expect it's going to go even lower. But, but, still understand, one bedroom in Manhattan will still cost you an average of $3,400, more than twice the national average. Now, when we talk about the incentives, like what are the incentives that landlords give? Well, incentives are basically things like if you sign a 1 year lease, you get 1 or 2 months for free, or we're going to forego the deposit, or you get a free TV, or it comes free with free internet. So people get, or parking, for example. So it's going to, people are going to get very creative of how to get people in to those areas. We've seen this in the 2008 crash. We've seen those incentives where you would see drive around the town. I remember I was in Phoenix, Arizona at the time, and you would drive around the town, and there would be these big signs that says, apartments for rent, get 2 months free plus free cable TV plus a free TV unit and 2 months of internet free, and free parking. Like a lot of things were free. So that's kind of what the incentives are. Weakest segments of the rental market is large family-sized rentals. And they're basically talking that, it's those 2, 3 bedroom apartments that family would want, but families are moving away. People don't want to be in a city for the reasons that we discussed. But let's recap them here just in case you are lazy and don't want to watch previous episodes or don't have time for that matter. And the reason for that is because they've been locked up, right? So everybody's working from home, everybody's studying from home. People are sick and tired. They want more space. They want the yard. They want to be able to escape. They want to be able to go outside, even if they can't. So you can go into your backyard, still get some fresh air. Kids can go play outside, and you escape all of the riots and all of the other challenges and problems. Okay. So number of new leases signed for 3 bedroom rentals in Manhattan fell by 42% in June compared to a year earlier. Downtown Manhattan and East Side are getting hit the hardest, with a 41% in rental downtown and 49% drop in the East Side. Okay, so this is kind of understand that this is not just happening. I mean, it's happening everywhere, but there are going to be pockets even within your cities. So it's important for you to understand where are these pockets, where are people going and transitioning to, where are the large drops. Now we have something else that is affecting. Remember, we talked about the whole concept of real estate. What happens when people move out of cities and states? Well, businesses no longer have consuming. Nobody's going into the stores. Nobody's walking around. Nobody's using stuff. So how does that affect businesses? Well, guess what? If you are a physical store business, nobody's coming in. That means money is not coming in. If money is not coming in, guess what? You can't pay your employees. You can't pay the rent. You got to close down. You got to exit. That has an impact on commercial real estate. How does that affect cities? Let's talk about it right now. New York has hemorrhaged tens of millions in real estate tax revenue. New York State lost $139 million in tax revenue generated by combination of residential and commercial real estate sales between March and April of this year, and $72 million last month alone compared to April 2019. The decrease marked a 64% loss from March to April in 2020. That's a huge loss in 1 month only, y'all. 1 month only. And this is just, right, this is lagging. This is just March to April when people couldn't even leave the state because they were locked down. It is going to be interesting to look to see what happens April to May, May to June, June to July, July, August, August to September, because these are hot months where people are actually moving and leaving. Nobody wants to move when it's too cold and rainy and sleety and snowy and that kind of stuff. People typically move spring through fall. Then you sort of suck it up for the winter and then you move back in the spring if you don't like it. 48% lost from April 2019 to April 2020. This is huge and it's going to grow even higher. Real estate sector is the city's economic engine. Investment sales, which include multifamily buildings such as offices, garages, gas stations, industrial properties, hotels, retail, commercial condos, and so on, saw the largest decline in transactions, resulting in a 71% decline trend following similar revenue losses across the country. So this is not just New York City. Remember, I am using New York City as an example of how this is affecting all cities and states, not just in the United States, but around the world. It is important for you to understand. Real estate industry provides more than half of cities' total annual tax revenue in the last fiscal year, more than double the contribution from personal income tax. Many people think that income tax is what drives all of the stuff, and it helps, but it doesn't drive it. Because when you have an employee make, say, $50,000 a year, there's only so much you can tax them, right? Even at 40%, even at 50%, out of the 50,000, you only get $25,000. That's not a whole lot for the city, okay? But if you have a $25 million property, or you have a $50 million property, or a $100 million property, and you tax it at 5 or 10%, now you're getting millions of dollars in revenue, not just a few thousand. This is key to remember and understand. So when real estate is not actually being profitable and things are not happening. This is why it's such an important sector to understand and pay attention to, is because it feeds the city, it feeds the schools, public transportation, maintenance. We've talked about it, right? So you got to understand that component. Now, New York City has something else, which a lot of places have as well, which is called the mansion tax, which is those large properties, very expensive properties. Mansion tax now ranges from 1.25% for a $2 million sale to 3.9% for a sale of 25 million or above. Transfer tax increased from zero point 0.4 to 0.65. I need water, y'all. So now imagine people are not paying rent, people are not buying and selling. So that means, and all of those things that are happening are stopping. So income is not coming to the cities, right? And so they are basically not getting salaries. And here, right here, I didn't highlight it, but I want to read it because it is important. Tax revenues fund essential services such as salaries for first responders, building service workers, MTA employees, which is public transportation, maintenance of public parks, vital repairs, maintenance to the public transportation system, schools, and so on and so on and so on. Now, people are leaving metro areas, but they're going into suburbs. Now, what is going to happen to suburbs? Well, suburbs are going to see an influx of cash. Some of the states that people are immigrating out of and into are going to see an influx of cash, and we're going to see some of the shifts over there where the prices and rents are going to go higher. That is why, as a real estate investor, it is important for you to sort of play the game of diversification and be in multiple areas. A lot of times, real estate investors make a very key, crucial component and error, and that is that they all pile into one area, one city, because that's what's booming. Don't do that. You want to go in and actually spread the wealth, as they say, literally and metaphorically speaking, I guess. So you want to be in a few different key areas because they behave differently, okay? You need to understand that. So when you are looking to invest, you want to start investing where people are going to go, where people want to invest, where people are going to think through. And we used to talk about where people can find employment, but now with employment going virtual, just about everywhere. And I don't think that that's going away anytime soon, y'all. Now you have to consider that that is not going to be the key driver, especially for higher paying jobs. Higher paying jobs are going to be virtual and they're going to remain virtual in the unforeseeable future. That is my personal and professional prediction. Now, here is what the trouble in commercial real estate means for you. San Francisco, yes, we're switching from East Coast to the West Coast. San Francisco's iconic Transamerica building is being sold at a discount. Originally, there was a deal that was struck to sell the property for $711 million back in February, but now they have agreed to drop the price by 10%. Disruption has two time horizons, short term and long term. Short term is unpaid rents and vacant properties, which means financial losses for the owners, financial losses for the investors, financial losses for the banks, financial losses for the cities because they're not getting all of the taxes and stuff. Then we have a long-term problem, which could lead to permanent reduction in the value of certain kinds of real estate, especially commercial real estate. And we're going to talk more about what other properties are going to be affected. It isn't just a problem for people who own buildings. Many people think, "Oh, well, this is just a problem for the business that that owns the property, right? It's the landlord's problem, but it's not." Remember, we've been talking about it for a little bit, so you got to understand this stuff. When buildings fall in value, that's usually because fewer people have cause to work and shop in them, which corresponds to reduction to income and consumption for individuals, right? We talked about it. Here it is again. Cities and states depend heavily on taxing commercial properties and the activity that occurs in them, all of those sales taxes, right, for states and cities that have them. A shock to commercial real estate values is likely to cause yet another problem for state and local government budgets. Deficits for real estate, the outlook seemed diciest for the retail real estate. Now, retail real estate is basically, Macy's, right? The malls, the shopping centers, that kind of stuff. And, you know, uh, uh, that has been on decline for a very long time as online has started to grow. But coronavirus has just sped up the whole thing. And basically, the landlords have very little recourse when tenants don't pay. What are your options? You can kick them out, but then you still have a vacant property that is still not being paid. Now you got to go and shift and find somebody else to jump in. Okay. And so who can you find? Well, you can go in and find a restaurant, which is probably the riskiest, not probably, definitely the riskiest business that you can get into because they say that roughly 90% of businesses that get started within 5 years disappear completely. In restaurant business, that number actually jumps to 99.9. So the profitability in the restaurant business is super, super low, and the chance of those businesses thriving is lower every single year. Now, prior to COVID-19, what did the landlords in the retail space do? Well, they looked at at restaurants, some of them. Then they looked at things like gyms, spas, bars, clubs, and that kind of stuff, thinking, right? Uh, Maybe a consumer doesn't have to go into a man's warehouse, for example, to go in and buy a suit. Maybe they can buy it online, right? So we're going to shift from that kind of retail into the gym because for them to go into the to work out, they have to go into the gym to use the machines, to lift the weights and all of that stuff. That was sort of the cushion that people were looking to switch into. But then what happened with COVID-19? All of that stuff shut down, right? When all of that stuff shut down, what ended up happening? Well, people started getting creative. Now you can get free yoga classes, free workout classes, all of that stuff on YouTube for free. And there's now these high-tech mirrors. There are workout mirrors. I can't remember the name, but you can probably search for it online. And it's basically like a mirror that it gives you an exercise, and you can actually, do that stuff just like you do in a gym in a live class. You can actually do that here. People are offering free workout classes through Zoom and that kind of stuff. And people are starting to cancel things because they're realizing I don't have to have this very expensive machinery inside my house. I can use the thing called calisthenics, right? Where you can do push ups and pull ups and sit ups and squats. And maybe you buy a few barbells or dumbbells or whatever. They don't take a whole lot of space, and you can get them for, I don't know, 20, 30, 40, $50, which is basically typically 1 month subscription to the gym. And, that's basically how you end up being fit. You go for walks, you go for runs, you find a tree, you do some pull ups, you turn yourself upside down and do some, overhead presses. So you can get very creative of how you can work out without going to the gym. So now, where these retail investors in real estate were looking to basically shield themselves in, are following themselves back into the same exact trap. Now, let's switch off to the offices. Outlook for offices is less dire. The argument is here. Most office tenants have been paying their rent. Most office using businesses remain operating even if their employees aren't in the office. Now, in the long run, so there's a component here that is saying it's less dire because many of the businesses, in case you don't own commercial real estate in the office, most of the commercial real estate, when you sign these leases, there are 5, 10, 15, 20, 50-year leases, okay? So there's the shield right there potentially within this industry. However, there is a problem there that some of the businesses in the long run, if companies like Facebook, and they're using Facebook here, but think any company, make good on their plans to have more employees work from home, which I believe is the future, there could be a permanent decline in demand for office space. So what is going to happen? More businesses are going to realize, wait a minute, we've been talking about this, y'all. Wait a minute, my employees are equally as productive, if not more productive, but now I don't have to pay for internet. I don't have to pay for the space. I don't have to pay for maintenance of the space. I don't have to pay for the parking lots. I don't have to pay for security guards, security cameras, internet, office furniture. All of that stuff is a large overhead. What I can instead do is say, all right, employee, congratulations, welcome to company ABC. You are working from home. You're going to supply your own office furniture. You're going to supply your own internet. You're going to supply your own computer. We're just going to give you a VPN, which is nothing compared to all the other stuff. And you're going to be working from, home. These are the meetings. We're going to be doing Zoom things, Skype things, whatever other things like Google Meet or Teams or whatever it's called. So there's plenty of places and spaces to be able to work and be very, very productive from home. And, the employee is going to like it too, because you don't have to sit in traffic. You spend less money on the gas and the sort of wear and tear on your vehicle or public transportation. You don't have to dress up. You can wear the same stuff that I'm wearing, which is t-shirts and shorts, or when it gets cold, it's sweatpants. So you get much more comfortable in kind of how you can work and how you structure your day. You can still hang out and socialize with folks, but you just do it virtually, kind of like what we're doing here on onedealaway.com. And we've been with it. One Deal Away is as you know, it's an educational company, and the team is global. I've never met my team in person. I mean, I've met them in person virtually like this, but we never sat in the same office space or in the same, location to work. And we're working just fine. We're developing just fine. We're growing just fine. We're delivering just fine. So you don't need space. And when you eliminate that, that's a huge cost and expense to the business that when you don't have it, all of a sudden you're not cutting your cost 1%, 5%, 10%, you're cutting your cost 50%, 80%, 95%. And that is huge because it gives you larger revenue. Now you can also play with the prices because you can offer more competitive prices than anybody else. And you can actually win people over with it. Okay. So you get more productive. You get to be able to participate in the new deflationary environment with offering cheaper products and services, while your profit margin is actually equally as good, if not even better. Additionally, you lay off a lot of people, which I'm not a component or saying you should, but I'm saying companies will, because if you don't have a parking lot and you don't have the security guard on that parking lot, you don't need the security guard for that. You don't need maintenance people, you don't need landscapers, you don't need any of that stuff, because you don't have to have them because you don't have the space. Let's continue. Because a lot of real estate is owned by publicly traded real estate investment trusts, the REITs are actually dropping, and that is affecting the market. Now, the REIT is a real estate investment trust. REIT stock price reflects the value of the equity interest in portfolio of buildings, net mortgages, and other debt the REIT takes out, and it should move up and down more sharply than the value of the underlying buildings. That is one of the reasons that I am not a big person when it comes to REITs and don't like them, for the fact that they're much more volatile than the underlying asset. That's A. B, you also don't understand always or know always what exactly they're going to buy or sell, or how well they're going to manage that place. Okay. So that is another thing, is because you have zero control, zero ownership. Remember, not your vault, not your gold, not on a title, not your property. You don't control it. You don't own it. Period. End of conversation. Moving on. Not the end of the not the end of the show. Outlook is probably best for residential real estate, and I agree. Average transaction prices have fallen sharply in New York and some other markets. However, that could be because transaction volume have fallen more sharply for the most expensive kinds of homes. And why is residential real estate probably the best? Reason for that is because people need a place to live. Okay, they always will. They always have. That is not going to change. What might change, what will change, is the type of property, size of property, location of property, price of property, all of those different things, and amenities that they're looking for is going to shift from time to time. However, the fact that people need a place to live is not. One of the moves that we are seeing right now, we talked about, I want to say last week, if not week prior, is the fact that people are looking for some amenities they never looked for in the past, like gym, pool, backyard, larger, the better, a place where they can do their own farming, right, to grow their own food, or maybe have some chickens for their own egg, or a goat, or whatever, right? So those are the things that are important. And finally, most important thing that you as a real estate investor should be considering and thinking about is office space. Where are your tenants going to work? And so that is one of the things that I have been working on my properties, is reaching out to my tenants and saying, hey, I know that you're working from home. Everybody's working from home. What are the things? How can we make this property better for you? How can we create some office space for you? What can we do? So what I am actually doing right now is utilizing a basement. I have a very large basement in one of the properties, that is a multi-tenant property, and it's much easier for me to utilize the basement, because right now it's not utilized. It's very large, it's very open, it's very clean. I like to keep things clean, and so we're going to actually go in and do a little bit of a construction job down there, where we're going to create these offices where people, almost like cubicles, if you think about it, kind of like what you have in office buildings. We're actually going to use the basement to create cubicles for tenants to live into the who are living in a property, to be able to use it. And we're putting Wi-Fi extenders, so that folks can actually extend their own personal Wi-Fi down to the basement. And now they have an ability not just to work from their homes, which many of them will continue to do, but what we're finding is that when you have couples or you have families, it makes it very, very challenging, because right here I am right now working, although I'm having a lot of fun. So, and I always encourage people, do what you love, y'all. Do what you love. And now is the best time to switch into what you love. But for me right now, I'm recording. I am loud. I am probably obnoxious. And if I had a partner that we were living in the same apartment, they could be in the other room, but they can still overhear me and I can overhear them. And it could be very, very annoying when people are trying to be on the call. So people are getting very creative by working from closets and bathrooms and kitchens and all kinds of stuff. So what we're doing right now in my properties is looking at spaces that we don't have that are going to be easily able to convert to create office space for folks, to provide some of the dampers. You can get some of those sound clouds and that kind of stuff. I'm not talking about soundcloud.com or whatever it's called where you can broadcast your message. I'm talking it's actual, I think it's called like a ceiling cloud or whatever. It's a sound barrier that sort of muffles and kind of holds on to the sound within the cubicle so that people can't be next to each other, but they are not necessarily overhearing each other, and give people a little bit of a space to go in and work. And so that's kind of what we're looking, but that's something you should consider within your space. And it also will increase the value of your property. Okay. So price index from Zillow show much more modest changes in residential rents and prices that you may have seen in some headlines. Zillow estimates after adjustment that residential rents were 2% higher nationally than they were a year ago. However, as of May, we're down less than 1% in New York area. And we've been talking about this stuff that many of the areas around the nation, especially in suburbia, and smaller places where people actually want to go in. They still get all the services, but it's not as crowded, it's not as risky, and from many different levels. And in those areas, we're seeing prices go up and rent go up. Very key to understand. All right. Now, residential real estate faces just one kind of risk, which is the economics of the individual. And we talked about it that July into August is going to be the riskiest component because people are going to lose that $600 a month. The eviction pieces are going to be lost. The forbearance and stuff is going to go away, and we're going to see major shifts happening from there. But it's just one risk, it's just on the income. However, when you talk about commercial real estate, they face not just the income based, but also risk of permanent COVID driven changes in usage patterns, meaning people are not walking into the physical locations, they're going online. It's double sided edged sword over there, whereas on the real estate, it's just one sided. Risk commercial real estate poses a challenge for city governments. We talked about it. New York commercial real estate is taxed at rates several times higher than owner occupied homes are. And that's not just in New York. This is actually nationwide as well as globally. They tax the investment properties and commercial properties at a higher rate. New York, like many cities, depend heavily on state sales taxes generated in restaurants, retail stores, and New York State benefits from income tax it collects from residents in New Jersey, Connecticut who work in the state but consume fewer public services, like they don't use as much public transportation, kids don't attend the schools, and so on. And a weaker commercial tax base is forcing the city and state to rely on more taxing residents of their income and residential properties or to cut back public services. We're going to see many cities struggling. And what is this going to mean? Well, it's going to mean a couple different things because I want to explain what does this actually mean to you and I. It means a few different things. One of the things that it means that it's probably going to cut some of the services is going to depend a lot on the federal government and wanting to print. So we'll be printing way more money. And I don't think that is going to stop. It is going to continue. We're going to look at potentially higher taxes on the online sales. Okay, so that's something that you can expect. We're going to see probably higher taxes on the real estate as a whole. So prepare for that. If you're an investor, you definitely will want to pay attention to that piece because that is going to be something that is going to be happening. Probably higher taxes on the transfers and so on. So that's kind of where I expect things are going to go. Again, as I always say to everybody, My crystal ball broke years ago. What I share here with you is not financial advice, it's just my thinking, my way of thinking. You gotta do your own research, you gotta connect with your own financial advisors, your legal advisors before you do anything else. So, this wraps up the show today. Again, thank you very much for watching. If you're live, we're about to go into the Q&A chat. And if you're watching this on YouTube, again, do me a favor, hit the like button so that we can send this message to as many more people. Feel free to share this message with others that you know, love, and care about. Do subscribe, do hit the bell button, and I will see you tomorrow. Until then, stay forever money blessed, and do remember, you are only one deal away.